Welcome to another episode of Tank Talks, your personal think tank for all things startups and venture capital. I'm your host, Matt Cohen, founder and managing partner at Ripple Ventures. On today's show, we are talking about how investors should think about investing in the next big thing with our incredible guest, Nikhil Basu Trivedi, co-founder and general partner of Footwork Ventures. Nikhil has been on the leading edge of investing in dozens of startups just before they become the next big thing during his time at Shasta Ventures for 8 years. He started out as an associate and eventually made his way to managing partner before leaving to start his new venture fund, Footwork, earlier this year with Mike Smith from Stitch Fix. Nikhil's portfolio includes several high-flying startups such as Class Dojo, DoctoronDemand, Canva, Hinge, Zwift, Tonal, The Pill Club, and many more. On today's show, we asked Nikhil what sorts of data points he looks for when analyzing markets and startups in order to time the next big thing perfectly for investment. We dig into some of the biggest lessons he's learned about seeing through the hype while trying to stay grounded in reality. We talk about market sizing and timing and how he avoids believing in his own bullshit. Finally, we asked Nikhil what trends he's following closely these days and what his plans are with the new $175 million venture fund, Footwork, and what kinds of entrepreneurs he's most excited about. But before we get started today, I wanted to share some exciting news for us at Tank Talks. Some of our listeners may know that I started my professional career at Royal Bank of Canada fresh out of college on the equity sales and trading desk back in 2007. My time at RBC, both in Toronto and down on Wall Street, New York, were instrumental in providing me with incredible opportunities in the capital markets industry. Now, several years later, I am proud to announce that Ripple Ventures and Tank Talks have partnered with RBCX to support visionary technology entrepreneurs across the US and Canada. With the recent launch of RBCX, founders and startups are now able to access a full-service platform to accelerate their entrepreneurial journey at every stage of growth. With not only access to innovative capital solutions, products, and services, the team at RBCX is offering solutions for technology clients across their entire company lifecycle, from inception to IPO and beyond. The amazing team, led by Sid Paquette, along with Nicole Kelly and Anthony Muchentoff, are well known in the startup ecosystem, and we couldn't be more excited to partner with them on Tank Talks. Listeners of Tank Talks can get set up with an intro meeting with one of RBCX's team members by visiting rbcx.com and mentioning Tank Talks to get set up today. Now let's get into this week's episode with Nikhil Basu Trivedi, co-founder and general partner at Footwork Ventures. Thanks for joining us in the tank today, Nikhil.
Thanks for having me, Matt. Thrilled to be here.
I've been looking forward to this conversation for quite a while, as you and I have chatted a few times before starting your newest venture fund, Footwork, and I've been a follower of your work at Shasta Ventures, along with your NBT Next Big Thing newsletter. As I mentioned, today I want to talk about how investors should think about investing in the next big thing and how you've been able to make a career out of it. You know, it's no secret that investing in some of the big overarching trends as they wash over society has put many investors on the map as luminaries of the venture industry. We've got e-commerce, digital payments, blockchain, electronic vehicles, and more recently, space travel are just some examples of the next big trends that have been adopted by the rest of society. In your mind, how do you describe the idea of investing in the next big thing to non-venture investors? And why has it been so difficult to be successful for this for the last several decades?
The reason that I started writing this Substack was part of the incredible privilege of being a venture investor is getting to sort of feel like we're seeing the next big thing before everyone else does. And, of course, that's the job of an entrepreneur to sort of create that next big thing, and the job of us as investors to hopefully invest in it before it's obvious and before a lot of other people see it. And so the way that I describe the idea of investing in the next big thing is it's hard. If it were easy and if it were obvious, then lots of people would be able to do it, and lots of founders would be able to create whatever that thing is. And so that's the most concise way, I think, to put it. And I think why it's difficult to be successful is you invest in something in year one, but 10 years later, lots of things have changed, and it typically takes several years to build that next big thing. And so sometimes your hypotheses are right about what will change and how the waters will shift to unlock more and more opportunity for yourself. And sometimes you're not. And I think when you look at the biggest outcomes and the biggest companies that get created, they all inevitably create market opportunities themselves. They dramatically expand the market more than anyone else thought was possible. And it's retrospectively lots of little shifts that enable that. But it's really hard in the moment of starting a company or making that early investment to know what those shifts are going to be.
Yeah, I mean, absolutely. If it was easy to predict the future, we would all do it. Basically, there's no shortcuts in venture investing on new trends. And if there was shortcuts, they would just be called the way that everyone would try to do it, right?
Totally, totally.
Yeah. And I mean, in the Crossing the Chasm book by Jeffrey Moore, he's argued that there's this chasm between the early adopters of the product, who are the technology enthusiasts and visionaries, and the early majority. And the model describes these visionaries and pragmatists as having very different expectations and suggestions techniques to crossing that chasm successfully. So in your opinion, what has been one of the biggest lessons you've learned about seeing through the chasm without completely turning into an eternal optimist, or on the flip side, an eternal pessimist?
Yeah, the biggest lesson for me is really trying to figure out what is the ground source of truth about a business in the earliest days, and being sort of intellectually honest about, do we have strong signs of product market fit or not? Most companies that end up crossing that chasm are able to do it because they find strong signs of product market fit, even in a small group of people. What I think about as a potential investor, and what I encourage founders to think about, is even if it's just a small demographic and sort of small subset of users, have you built something that they absolutely love? And what data can you point to that shows that to be true? I'll give you an example from the real world. If you look at Facebook's journey as a case study in this, and of course they started off in colleges, and then they went to high schools, and they expanded beyond to the broader population. But what was impressive when they were just at Harvard, one college, was the penetration they had within that student body, and the depth of engagement and retention they had within just that student body. And so even though you had to make several leaps to figure out, okay, how is this going to cross from college students to the majority, you could see that there was something these college students really, really loved in the earliest days. Very similar story for Snap. I would argue, frankly, for pretty much every social product, there's a story like this. So anyway, that's just one example that hopefully brings that to life.
Yeah, I think, it's your job and our job as venture investors to figure out what are those data points that are valuable to rely on, that allows you to see from the early adopters, like you're saying at the Harvard student level, into the transition to early majority, who become real users and maybe, subscribers or customers of the product. But oftentimes it's not the first wave that you want to bet on, but sometimes it's like the second or third wave, which is exactly what happened in the social example of Facebook, right? If you were to bet on the first few waves with, MySpace and stuff, and Friendster, you would have had a lot of lessons learned, but probably not a lot of ROI to show for it until Facebook really came around. So how should you think about timing these waves, and what sort of data points help you decide when to step in?
Yeah, I mean, if you look at that example, a lot of the first wave companies actually had strong top of funnel growth. They had a lot of users sign up, and they had a lot of users invite other users to sign up. But what they didn't have was ongoing engagement. And what you couldn't see in those companies was 6 months in, the majority of users still actually being active on those platforms. And so what I look for is first really strong engagement, retention, and I think there's lots of ways to measure that depending on exactly what the product is. Maybe there's a core action that the user takes, such as getting tagged in a photo, or having other people tag them in a photo, or having other people that you tag in a photo, or maybe it's something like writing on someone else's wall or messaging someone. And so what you could see in sort of the second and third waves of social was a lot more actual engagement and usage of the product that drove longer term retention. And that just didn't exist in the first wave. And I think, again, if you wanted to go down the rabbit hole of chatting about crypto, for example, I think you could argue something similar is happening there, where there's a lot of excitement around a few different trends, such as non-fungible tokens, and a few now consumer experiences built on top of crypto. But there's been this interest for a while. And I think there's actually been a decent amount of sort of top of funnel growth in certain aspects of crypto for a while. I think we're just now starting to see actual usage and engagement and retention of consumer products built on crypto applications. And so that makes me more interested in that category than ever before.
I mean, yeah, let's open up the can of worms here and just go right into it. So, you sound like you're a person who really believes in trying to understand what value people get out of using products. So, you've got the segments and the full stories out there where you can literally watch and see what people are doing with your product and start to uncover these like golden nuggets on what it is that they see the value in versus what you may have thought or your hypothesis was when you set out to build the product. And, crypto is a perfect example. I mean, Fred Wilson just published a blog post on August 11th talking about how he thinks that the consumer experiences built on crypto stack are the next big thing, and how NFT experiences are showing the way similar to the way the left tackles are allowing you to run behind them into the opening. And that's just creating more opportunities for people to jump on this wave. So what are your thoughts on that and in terms of the NFT wave? And how should we be thinking about this opening up to way more opportunities than we just see in front of us today?
Yeah, it's interesting. So I wrote a post, I just looked it up on February 24th about one-of-a-kinds and NFTs. And what I wrote was, my thesis in crypto has been that the way for a product or service to become the next big thing would not be because it was a crypto or blockchain application. It would be because it was an amazing user experience that just happened to be enabled by these technologies. And I actually think Fred was saying something pretty similar. I won't ping him for any honor code violation on that. He's much smarter than me about this category. But I do think that what is interesting now is that we're seeing products, everything from NBA Top Shots in these basketball cards to So Rare, which is a sort of soccer card plus fantasy game, to Zed Run, which is sort of crypto horses that people are buying and racing with. What we're seeing through these applications is unique consumer experiences that a subset of people, it's still small, it's still, if you look at sort of the data off of these platforms, it's tens of thousands of people, maybe hundreds of thousands of people who actually own tokens on these consumer products. But in that small N, you're seeing a lot of usage of these products. You're seeing people buy again and again. You're seeing people, for example, with CryptoPunks, display their punk image across the web, whether it's in their Twitter profile or other sort of social products. And so it feels like, the usage of these technologies as a consumer first product in each of these examples is now happening. And that's what makes now a more unique time than ever. It still hasn't spread to the masses though. And so that's still the big question for me, is just how niche is this? And I think there's a sound argument that there are lots of forces that are just going to draw more and more people into this ecosystem.
I mean, I think there's this cycle though, where it sounds niche for quite some time, and then all of a sudden it becomes non-niche, right? I mean, even Boris Wirtz from Version 1, who was on the podcast, a few months ago, was talking about how he didn't even foresee how big it would be with Dapper Labs or even with Uniswap and DeFi and things like that. So like, it was really hard for him to even think about what the potential size of the next big thing was when he started thinking about making that small investment. So how do you think about the potential size of it? And when you start with such a small TAM, how do you stop yourself from getting carried away with being too overly generous with blue sky target?
Yeah, man, this is the hardest question to me in our business, is how do you predict how big a market will be? And if I look at the biggest misses that I've had in my venture career, it's massively under predicting how big something was going to be. And actually, even if I look at the successes that I've had, they've become more mainstream and bigger than I could have ever anticipated. I'll give you an example. Canva, which is a design software platform company. It's based out in Sydney, Australia, and was lucky enough to be part of the seed round back in 2014. Now, you could tell back then that, there were already, this was in month 5 or 6 after they launched the product, there were already hundreds of thousands of people using that product. It was growing organically 30 to 40% every month. You could see in every cohort that 30 to 40% plus of users were using the product. So there were a bunch of early signs of product market fit at Canva 5 months in. But the idea that so many people around the world were going to, design their products for free using Canva's tools, and the magnitude now of tens of millions of people who use that service on a regular basis wasn't fathomable for me, and maybe not even for Mel and Cliff and the rest of the team back then. I think, again, this is where the great companies build a product that just is so compelling that it pulls people into it who, were skeptics before, are not early adopters. So I think for me, it comes back to sort of the greatness and the specialness in the product and in the founding team or set of founders that are able to iterate to make the product more and more special and appeal to a broader subset of people along the way.
Yeah, absolutely. And I listened to the guy, Raz, how I built this podcast with the Canva team. And she said she did not even know how big this could really be at the early days. And even still later on, couldn't believe how big it got. And I think though, what I'm hearing you say, and what we also talk to our founders about at Ripple, is focus on the now and focus on how good of a product you can make for the now customer, not the potential customer that may come a couple of years from now. For example, VoiceFlow started out building Alexa children's stories on, smart speakers so that people could just have like bedtime stories to read to their kids that were interactive. Never once did we believe that would be used in a BMW car or as a McDonald's drive-through as a voice assistant. I mean, we had that kind of pipe dream, but it was not something that the product was being designed for at the time. And I think it's really important for founders out there to hear what you're saying. It's build for a great product now and iterate quickly based on what you're hearing from your customers, but don't think about how you're going to service the customers 2 or 3 years from now, right?
I think that's right. I mean, I think what you just highlighted with VoiceFlow is perhaps the most important point, which is it takes a special DNA to iterate on the product and find that next seam of product market fit. Going from children's stories on Alexa to being used in BMWs is a leap. And it's a leap that wouldn't be possible for that many teams. It takes a special team to make that leap and to iterate on the product and iterate on the go-to-market to find that next level of product market fit.
Yeah, absolutely. We are talking about some of these things that make that leap, but a lot of companies don't make that leap. And so I want to ask you about investing in hype, which seems to be the flavor du jour these days, with every company raising money based on hype, or at least the opposite of reality. So how have you tried to stay grounded in reality when making investments that seem to be purely driven by hype without believing your own bullshit?
To be honest, I just haven't taken that many bets on companies surrounded by hype. I've always been focused at the early stage. I've never been at, a fancy brand name firm that could easily win over the most hyped companies. And so I've had to do things a little bit differently, which is look at the ground source of truth, as I mentioned earlier, to see what's actually happening with this company, to see the earliest signs of product market fit, typically before I invest, and then to really analyze the founders in some of the ways I just mentioned to get to conviction that they're going to be able to figure this out. And oftentimes that means taking some level of hair and risk around the market, around some of the most hyped sort of ideas and categories. So that's been my approach. What I do feel strongly about is I worry about companies that have a lot of hype, that take a lot of capital early, well in advance of product market fit. And I think that's a recipe for a lot of brain damage. And there's, unfortunately, of course, plenty of stories like this. I think companies like Color and Quibi and others. I think it's one thing to have hype because you have something that's really working in the early days. And that can be worth capitalizing on, and that can deserve a lot of capital early. But the companies that don't have any product market fit, not even a launched product in the early days and raise a lot of capital, that really scares me, and I'm quite turned off by it.
It sounds like you really value founders who have a good sense of hubris and being humble about what they know about their product market fit versus what they don't know yet. We've seen some founders say, look, I know you want to give us X million dollars, but we don't know what we're building just yet is going to work with that much money. So we're going to ask for half of that. I love those founders. I think those founders are going to have tremendous success, even if they make a couple of mistakes along the way. And it sounds like you think about things the same way.
That's right. I mean, look, to be a founder in the first place, you have to be an optimist, I think. You have to be confident to just take the leap to go do something.
I like that. So I would love to talk about, the data points that you look for with Mike to determine the key signs of market shifts and how much data is really enough for you to feel like you're betting before the market has fully shifted.
This is at the heart of sort of how do you analyze product market fit and what constitutes product market fit. Obviously, this depends on what exactly the service is and what the company does, but data around engagement, of repeat usage, of highly retentive usage, ideally data that shows this business can have strong unit economics if it works, and at scale can be a great business is something that we like to focus on as well, even in the early days. Sometimes one of the things that we like to do is study a market and develop a thesis on a market. And by looking at multiple players in a market, one can understand whether a market has some serious tailwinds behind it or whether they're going to be certain headwinds that they face. And so, as an example, a recent investment that we made is in a company called Via, which is in the e-commerce infrastructure space. It's enabling brands and retailers on ecosystems like Shopify to sell on mobile and giving them the tools to do that. And Mike and I studied the space by meeting with several companies, a bunch that are later stage now and beyond Footwork. And we just found, wow, every one of these companies is working. There's like a profound shift happening here where selling on mobile, selling through SMS and other messaging channels is just working for a lot of e-commerce businesses. And so it felt like a trend that was just happening and worth betting on. And we saw that just by spending time with different founders in the space and e-commerce businesses themselves to hear what they were seeing live in the market. And then you can look at other data points, for example, in that trend, such as how much CACs are rising on Facebook and Instagram and Google, to see that brands do need to own the relationships they have with customers and can do so on mobile. And so just painting a complete picture for why a trend is happening now, writing it down is something I find to be a really useful exercise.
Yeah, so double clicking on that for a second. So ignoring the individual companies specifically, but on the market level, do you like to see money going in first before committing your capital, or coming out first in the form of exits before getting really excited about a market?
Well, I think if you wait for exits, then it's hard to be an early stage investor, especially given how long it now takes for companies to reach the promised land and ultimately go public or get acquired in a huge acquisition. So I can't say that I can wait for exits. I think you can look for precedents from other similar markets in the past, but even that's dangerous. If you think about Instacart as a canonical example, could have bet on Webvan, as actually some Instacart investors did, and sort of had a historical bias against online grocery, and then failed to bet on Instacart as a result. And so I think you can only look so much into what's happened in the past. And I think the best investors are the ones that are able to block out the past to a certain extent. They take their learnings from what's worked and what hasn't worked in the past, but that they apply a level of pattern recognition around a group of founders, around what's happening in the water of the market today, and around the early signs of product market fit to make that early stage investment versus relying on prior exits.
That makes sense. As an early stage investor, if you're waiting for the exits to come, you're not an early stage investor, or you've waited too long. But what about getting confused with signals versus noise as an early stage investor? For example, let's say you're looking at a company that's in the e-commerce space and you meet some companies that have already been backed, or you find competitors that have already been backed by the Sequoias and the Excels and the Andreessens of the world, and you found a new company that you're really excited about. Do you look at those other competitors that have already been backed as a blocker for you to get excited about a potential company? Or do you look at everything as a standalone basis? Because some early stage investors take that signal as someone else in the market already being pre-funded as a negative for them to say, why are these guys going to be able to compete against the already funded, Sequoia-backed companies?
Yeah, I think the answer to this depends on the characteristics of the market. And I wrote a post, I think a couple months ago, titled Many Winner Markets, where I discussed how there are some categories that have just led to a lot of winners. Let's take neobanks, for example, in financial services, or as I was just describing, this SaaS e-commerce space, or marketing SaaS broadly. Any one of these categories has led to a number of big outcomes. And I think that the tailwinds were so profound for each of these markets that they led to a number of big winners. But also there were characteristics in the market that were not winner take most or winner take all. I think that those markets that I just described don't have the kinds of network effects such as consumer social products have or consumer marketplace businesses have. And so, it's not as easy to build one dominant player in those markets. And when I see a market like that, I'm often comfortable taking an early stage bet in spite of competition. But when I see a market that I think has more winner take most or winner take all dynamics, there's more pressure on me to feel like I'm betting on the potential winner. Does that make sense?
Yeah, that makes sense. It's like you're okay betting on, let's say, the underdog at this point, if you know it's not a one winner take all type of market because you've studied it from a top down perspective. And that makes sense to me for sure. I mean, yeah, we're seeing that a lot more. There's many winner take all markets, especially these days with how global the world has become. But let's talk about some specific trends that you're excited about. Consumer versus enterprise trends are very different. We all know consumer trends can change every day and are much harder to predict. However, enterprise trends tend to happen slower and are a little bit more predictable. But with the pandemic, it obviously accelerated the entire remote work trend for enterprises. And so now that a lot of these enterprises have adopted the digital solutions far faster than anyone expected, what trends are you most excited about post-pandemic in the enterprise space?
There's a number of really interesting ones. One related to what you just said is, when you look at what companies are dealing with at the moment, I think top of mind for many businesses is how to build a culture in a remote company, in a hybrid company, how to bring people back to work in the office, how to motivate people after what's been a really challenging year and a half for many people. And so one of the things that I'm particularly interested in right now is just employee productivity, how to foster a culture, whether again, hybrid or remote or in person, that leads to real output. Because I think a lot of companies are going to be struggling with this, not just for the next year, but for a long time to come. It's very hard to undo, some of the stuff that's happened over the last year, where there's just a set of employees that are remote and will want to stay remote. And so I think we'll see a lot of pressures around that. So that's just one example of an enterprise sort of workforce, more HR trend that I think is really interesting right now.
Absolutely. I'm really excited about this trend as well. I was thinking about this when we had Nicholas Vandenberg from Chili Piper on the podcast, and he was talking about how they have a distributed team across like 30 or 40 countries, and they do an annual retreat once a year. It used to be in Ibiza, and now he's moving it down to somewhere in Cabo or somewhere. And he makes sure that everyone attends from around the company. And it's like a week where they all just get together and really get to build that human connection again. And I think we really lost that during the pandemic. And I hope there are some companies out there that are trying to make more use of the time we spend together, whether it's in conference spaces or co-working spaces or with your actual counterparties in your company, to find more ways to benefit from being together, because we definitely lost that. And maybe technology can solve it. I'm not sure, but I definitely think it's a problem that all enterprises are going to be struggling with in the next couple of years for sure. I would love to get your thoughts on some of the other trends that we're seeing. You write a lot about it on your newsletter, obviously, but one of the ones we're seeing a lot of focus on today is the clean tech investments, right? And deep tech investing. Unfortunately, a decade ago, a lot of VCs got burned on these types of investments. And now we're going right back into them on the clean tech side and maybe like the space tech side. So, what are your thoughts on this sort of new wave coming back around, and what sort of lessons and what kind of outcomes are you expecting this time around?
I think this is a really important area for all of us. I mean, unfortunately, climate change has only gotten worse in the 15-ish years since the first clean tech wave happened. And so I'm delighted to see a new wave of companies going after what we now call climate tech, and investors who are interested in the category as well. I think it's really important. And I think the sort of tailwinds and trend lines around this make it a much more fruitful time to invest in climate-related companies. Just given the urgency, I think many more people feel today than 15 years ago is just one aspect. Of course, regulation and other things that I think will hopefully force us to be a carbon neutral and then carbon negative planet. The one thing that I think is also worth pointing out is that the clean tech sort of bust was not entirely a bust. It led to Tesla, for example, being created and funded and now being one of the most important companies in the world. It led to solar dramatically falling in price. We now have much more solar energy than we had at the start of that cycle. And so I think all was not lost. I think it was actually the clean tech bust was painted worse than it actually was. And I do think this time around, it's incredibly important that we have many successful businesses come out of this for our planet.
Yeah, I agree. I think there's a ton of benefits that come out of these bust cycles that we see all the time, from the .com and the redistribution of the human capital that was built without the infrastructure ready for the time, in the last .com bust. And then in the financial crisis, we saw a lot of sort of these democratizing financial access and information companies come around, and the Ubers around. So yeah, I completely agree with you. I don't think this time is going to be viewed as a bust if it does, because of the demand is so much more pent up this time around than it was last time. So maybe they were just a little bit early from a market timing perspective. But I think all the human capital that went into it didn't go to waste, and it ended up creating companies like Tesla or maybe SpaceX. So, your newsletter, I read all the time. It's an incredible Substack newsletter. So thank you for continuing to put out such great information in there. I always love how much information you're able to process as a generalist. And there's so many trends that you cover. I got to ask, how have you been able to stay a generalist, jumping in and out of so many specific industries and markets, while still being informed and deadly enough to make investments in so many different industries?
I think one thing that's actually hard right now is there's so much capital, and there are many generalist firms, there are many specialist firms, and there are also lots of specialists within the generalist firms, that it's perhaps a little bit sort of contrarian or old world to be a generalist. But I think also one has to be authentic to oneself. And I've always had lots of different interests. I studied molecular biology ultimately in undergrad, but I took a lot of classes in economics and politics and international relations and computer science and a bunch of others in the engineering school. And so I've sort of always been this way. And I think part of why I love investing is getting to look at lots of different companies. I do think if you're going to be a generalist like me, you have to have some areas that you know better than others, and some swim lanes that you go really deep in, because if you just stay at the surface level of everything, you're unlikely to spot what world-class looks like in any one lane. And so I do have a lot of interests, and then I tend to go really deep in certain business models and certain sectors. And I also just let my own curiosity and passion sort of follow where I write and where I spend time with companies.
Well, I mean, it's amazing to see all the different things that you write about. And if something really gets you excited, it must really have to stand out, because being a generalist like you are, like we are as well at Ripple, you must see thousands, tens of thousands of really exciting things that you want to learn about. But going deep, as you say, below the surface, must really have to have something that makes you, kind of jump out of your seat for you to take notice. Is that correct?
That's totally right. And the other thing is, I think you can be a generalist and you can have things that just don't get you excited. I do have a few, categories, types of businesses that I'm just not that compelled by. There are lots of people interested in gaming for the future of the metaverse or metaverses. For me, I'm just, and what's happening in esports, you won't likely see me invest in a gaming company. It's just not a category that I'm super passionate about or feel like I have an edge in any way, or some unique perspective. I also just don't like businesses that are one-time transaction businesses, even if it's a high dollar amount. I love businesses that benefit from the potential of decades-long customer relationships, and so there's certain characteristics of businesses that I just don't get excited about, and I think it is important to have a little bit of that too if you're going to be a generalist.
Yeah, absolutely. So let's talk about that. You recently left Shasta Ventures after an incredible 8 years to launch Footwork Ventures with your partner, Mike Smith, who was president and COO of Stitch Fix for almost a decade. And you recently announced the closing of your $175 million capital fund to invest in early stage startups. Firstly, huge congratulations. And we can't wait to see what you and Mike accomplish together. But I'd love it if you can give our listeners some insights on what the fund is looking for and how founders should think about Footwork when considering a potential investment from you and the team.
Yeah, thank you, Matt. We feel lucky to be in business, and we've now made our first 3 investments. They are all companies where we led the seed or Series A round, where either Mike or I sit on the board of the company now, and so we have more of a disciplined, concentrated, focused strategy versus, we're not looking to invest in tens of companies every year. It's probably going to be, 5 to 8 investments per year for our firm. And in each one, we want a level of ownership that's meaningful, such that if the company works, it can return multiples of our fund. And so that's just our strategy. In terms of areas that we're interested in, you can look at our backgrounds and see that there are a few things that are likely to be interesting for us. Mike's been a commerce operator for the past 17 years at Stitch Fix and at Walmart.com. We would love to find the next Stitch Fix-like company to back at the early stage. We're also interested in the infrastructure layer of e-commerce, as I mentioned before, with the investment in Via. And so that's one very big area that we've been spending a lot of time in, related to sort of consumer-facing e-commerce. Consumer subscriptions, subscription businesses have been an area of focus for me for many years now, and we think we have a unique amount to be able to give to entrepreneurs that are building subscription businesses, given our operating and investing backgrounds there. And so that's another sort of swim lane for us. And then you'll see us write about areas that we're really interested in and going deep on. And so, we've written about mental health and the climate crisis, as we chatted about earlier. Those are 2 areas that we've been spending a bunch of time on this summer in meeting with founders in both those areas and figuring out sort of what is the right thesis for us to make there. And so if you're in one of those worlds, would love to hear from you to see what you're doing and to also help us sort of refine our thesis and to see if it fits in. Hopefully that gives you a flavor. And if you follow our, my Substack, you'll see us write about sort of more areas that we're going deep on in the years ahead.
Yeah, everyone should definitely be reading it. It's one of the best ones out there, as I mentioned. But lastly, what about blockchain and crypto?
I have been investing personally in crypto assets since I think about 2012, and we don't yet have a thesis for what we will do as a fund there, but we have a very open mind and we have the flexibility to be able to invest there. I think the thing that I'm most intrigued by is, as both I and Fred Wilson said in our different ways this year, consumer experiences that are magical experiences. They are magical because they have been built on blockchain technologies, and because crypto technology has enabled a unique consumer experience, and so I'm intrigued by that. And so if that resonates with you, please reach out.
Yeah, that's awesome. It sounds very similar to my views at Ripple. Personally been investing in crypto since 2014, 2015. And even though we have the same name as, a large crypto platform, we don't actually have any sort of blockchain specific focus at the fund, but I've been studying it and learning a lot about it over the last several years. So I totally agree with that. Before we wrap things up, we always like to ask our guests for their fast favorites. I'll list off 5 topics. You name off your favorite of each one. So first off, your favorite podcast.
The All In podcast has been actually quite a bit of fun for the last many months, and so I've enjoyed listening to those 4 guys.
Absolutely. Entertaining and very educational. Favorite newsletter besides your own, obviously, or blog?
I'll shout out Packy McCormick here of Not Boring. I think he's done an amazing job getting his newsletter off the ground over the past year. And I just find it, as you described with the All In podcast, educational and entertaining, which is a great combination.
Absolutely. Favorite tech gadget?
I still find myself being awed by AirPods. And it's kind of amazing what they've done for my ability to consume audio and get more done while walking around on my phone.
Look, AirPods are showing up probably 7 out of 10 times here on the podcast, so you're not one of the new ones here. Favorite new trend, and this is a tough one for you because all you do is talk about and invest in trends.
The number of exceptional founders that I'm seeing work on climate-related solutions is really inspiring for me. That's something that, to me, is a leading indicator around what we'll see in this climate tech world in the next many years.
Yeah, very exciting. And last but not least, your favorite book. 2
of my old-time heroes wrote a book together. Sir Alex Ferguson, the manager of Manchester United for 25 years, and Sir Michael Moritz, the partner at Sequoia Capital for several decades. It's called Leading. And it's on my mind because we're sitting here in August and the Premier League season's about to start tomorrow. And that's a terrific book about football and venture capital and entrepreneurship.
That sounds very interesting. I'm not a huge football fan, but I definitely think that would be an interesting one to give a read to. So I'm going to check that out. Leading. Got it. Awesome. Well, thanks so much for joining us in the tank today, Nikhil, to talk about investing in the next big thing with Nikhil from Footwork Ventures.
Thanks, Matt.
Thanks for listening to another episode of Tank Talks. To learn more about this episode, be sure to go to Apple Podcast or Spotify to find more detailed notes on this episode or to check out previous episodes. Also, if you enjoyed this episode, please leave us a review and a rating as it helps us out a lot. And hit that subscribe button so you can get notified when new episodes come out. Finally, make sure to give me a follow on Twitter @MattyBCohen or @Tank Talk Podcast to stay up to date on new episodes or to be a guest on our show. Till next time,